Wonderful. Thank you so much. Thank you for being here with us today. Good afternoon. Welcome and thank you for joining us. Rowan University's Women's Alliance Network is proud to present to you today's event, Recharge Your Wallet with TD Bank. My name is Denise Dennery. I'm the interim chair of our Women's Alliance Network. We warmly welcome today Rebecca Bear, Vice President, Private Client Relationship Manager with TD Bank, and Rachel Seaman, Store Manager, TD Bank, College Drive. I would also like to acknowledge and thank Heather Quinn, Vice President, Regional Field Marketing, in our audience today for helping us to organize today's event. TD Bank has graciously been awarding grants to our advisory board for years to help make these events possible and has been such a strong supporter of Rowan University. We thank you. We are also extremely appreciative of not only TD Bank for its support, but Rowan leadership for its support, and especially for being many of our past presenters and attendees at our events. Today, Rebecca and Rachel will share their expertise and valuable insight surrounding common financial topics, financial management, and planning advice that can be implemented throughout all stages of life. I would like to read to you a little bit, go into their backgrounds, and then turn today's event over to first Rebecca Bear, who will share her presentation, and then we'll go to Rachel Seaman. But first of all, Rebecca joins us today as a private client relationship manager. Rebecca delivers TD Wealth's full offering of private banking, lending, and investment trust and estate services to high net worth individuals in her market. She works closely with each client to assess their needs and develop a comprehensive plan focused on their financial goals. In executing upon this strategy, she leverages the resources of TD Bank to assemble a team of specialists to fulfill the many needs of each client. As the primary point of contact, she develops an extensive relationship with each client and works closely with the team assembled to support their needs. Prior to joining TD Wealth in 2021, Rebecca held roles as a senior wealth management banking advisor at Bank of America Merrill Lynch and as a financial advisor, Citizens Investments Incorporated. Rebecca is a graduate of Russell Sage College with a bachelor's degree in psychology and human services. Rebecca currently holds her FINRA Series 7 and 66 registrations. Rebecca is a school board director for the East Stroudsburg Area School District, and she serves on the board of the Institute for Human Services. Rachel is vice president and store manager on College Drive. Rachel joined TD Bank, the team, in 2018. She has over 20 years of banking experience from retail to training and development. Rachel has a passion for connecting with people. She enjoys building strong, ongoing client relationships. Rachel believes that by listening and by educating her clients, she can help them achieve their financial goals and make their day-to-day banking easier and more rewarding. Rebecca, Rachel, we welcome you. Rebecca, do you mind starting us off today?
I would love to, and I am technologically challenged, so bear with me while I share my screen. I may not do it right, so but I'm getting better. So let's see if I can get this to work. Share.
Thank you.
Let's see. Can you see my slideshow?
Not yet.
Not yet. Okay, sharing the browser. Stop sharing. Hold on. It worked before when I practiced, so share content.
While you're getting this up and started, I wanted audience members to know that they can certainly type in their questions. We'll have some time for audience questions at the end of today's event. So please feel free to type in your questions in the chat feature.
Let's see, slideshow. It's not letting me go to the slideshow.
Click on slideshow. Let's see if that brings up the options to start from the beginning. Yep, you want to go from the beginning.
From the beginning. Ah, there we go. Wait.
Beautiful.
Yay! Okay. Thank you, everybody, for your patience. As I said, I'm technologically challenged, and my 2 children are not here. They're in school, so they can't help me like they usually do. So welcome to my presentation. Let me just get there. So it's important for a successful woman to know several different things. And we're going to have my little lady pop up as we go through. The average life expectancy for a woman, if they reach age 65, let's see, with a third of the world's wealth under their control, women are adding $5 trillion to the wealth pool globally every year. 39% of women in the nation's investable assets are decision makers. So we are the growing population of women. We are controlling more and more of the decisions of the financials in the world. Half of our net worth of women say they come into their relationships with as many more assets than their partners. So we are better savers than men. Technically, men are more spenders. So we bring more to the relationship than they do. 40% of the high net worth women say that they are equal or the primary income earners in their families. 92% of women say either they make our share in making the overall financial decisions in their household. I know in my household personally, my husband has absolutely no clue when it comes to our finances. 47% of women believe that their investment decisions are a way to express social, political, or environmental values. Nearly half of women aged 67 to 80 have less than 75% of their assets with their primary advisor. 83% of female executives have between $3 and $25 million in investable assets, and 17% have greater than 25 million. 77% of women want to invest in companies with diversity in leadership. And this is more common among women than men to want to invest more socially responsible. 70% of women switch their financial provider after their spouse passes away. Women are nearly half the labor force. Women now hold 52% of management and professional related positions. And it's growing every year. More and more women are getting those type of positions. As of 2018, there are 12.3 women-owned businesses in the US compared to way back in 1972, the year I was born, when there were only 402 women-owned businesses, representing 4.6% of all firms. Currently, women own 4 out of every 10 business. And I'm sure since this data was compiled in 2019, it's even more. More and more women are opening businesses during the pandemic, and they're succeeding. 2007, the number of women-owned businesses increased by 58%, which is better than the overall businesses in general, which only increased by 12%. And women are slightly more likely to start a business than men. Here's an interesting fact, too, as we get older. Older men are more likely to be married than older women. About 3/4 of men between the ages of 65 to 74 are married, compared to only 58% of women in the same age group. Among men over 85, nearly 60% are married, but only 17% of women are married. And that's a lot to do with possibly men don't live quite as long as women do, or women don't tend to remarry as often as men might. On average, women retire at age 62, and we have a life expectancy of 81, and that's increasing as modern technology improves, requiring us to have almost 20 years of retirement savings. At some point in their lives, 9 out of 10 women will have the sole responsibility of their finances. And unfortunately, 39% of marriages will end in divorce. About half of all mothers who have custody of their children have child support agreements. However, among those who have child support agreements, less than half actually receive the full amount of support they're entitled to. And more than 30% of child support payments are never even paid. Women are more likely to be the primary caregivers for older relatives, including the parents of their spouse as well. So not only are they taking care of their own parents, they're taking care of their spouse's parents as well. These are some life events that we need to think about as we plan for our futures. We plan for marriage. What are we bringing into the marriage? What assets do I have? What assets does my spouse have or my partner have when we join union? But will it end in divorce? What happens in divorce? Who gets what? We're planning for our next generation. Will we have children? Will we adopt? Will our children go to college? What type of plans do I have in place for college? And also, when we're that age between 30 and 55, we're known as that sandwich generation. And what that is we're not only taking care of our own children, but our parents and our spouse's parents are now aging. And we're now required to take care of two, not just our children, but our aging parents. And we're sandwiched in between. Are we planning for widowhood? What happens after my spouse passes away? Do I have enough assets in place? Is there a plan in place for me to take care of myself? Long-term care insurance? Do I want to be charitable? What charities are important to me? Do I want to leave money, or what kind of charity do I want to do while I'm living? And do I have enough for retirement? These are all things that we do need to consider as we're getting older. Some key concerns I find with my clients are, will my money last? Did I save enough money to live the current lifestyle that I'm currently living? For me, my friends always laugh at me because one thing I always say, as long as I have enough money to pay my mortgage, take care of my children, pay my electric bill, and enough money to buy my shoes. I am a shoe addict. And unfortunately, my son has also become one because of me. And every day with his part-time job, there's a new package coming every day. So I created a monster. And I have to make sure that he eventually plans appropriately as well when bills start to happen. Will there be money left over for my family? Things to think about. How long will I have to save? Plan to live longer because, as I said before, technology and healthcare advances are increasing our life expectancy. Always have a safety net too, because what if something happens? There's always that unexpected that could happen. And it's important to separate our needs, our wants, and our wishes. Inventory your future income sources and consider transition options. It's important to start by thinking about your vision for the future. I personally like to do a vision board where I cut and paste things onto a board, which helps me visualize what life is going to look like, not just the future, but short term, midterm, and long term. Consider whether you retire or if you want to continue working. And the important thing is, where do you want to retire to? Because that can also affect your plan. I personally live in Pennsylvania, and I joke to people, Pennsylvania, unlike New Jersey, is probably one of the most expensive places to pass away for our beneficiaries because of state tax rules. So it's important to consider too where you want to retire, because that could also affect how you do your estate planning. Know your income sources and estimate what your ongoing expenses might be. Adopt a long-term perspective towards your investment and plan. Work with a trusted advisor to evaluate assumptions and options. Where are you going to get your income sources? What are your goals? How should you invest the money to get to from point A to point B to point C? And remember that plan is always evolving because unfortunately life happens. So it's important to review your plan annually and track your plan's success towards your goals. And it's okay to add new goals, remove goals as you see fit when you meet with your advisor. And understand the fees and costs to work with your advisors. So defining your goals. A short-term goal may be, saving and paying off debt. A midterm goal would be as a not for me anymore, unfortunately, because my children are 14 and 17, and I started this a while ago, but investing in your child's education. And remember, education costs are going up. I know when I went to college, it cost about $19,000 to go to school for a private institution. I went to Russell Sage College. Now for my son to go to a private institution, we're looking at anywhere between $50,000 and $60,000 a year to go to college. So that's something to really think about as we plan. Planning for retirement. How much do I need to save in order to maintain my lifestyle that I like to live? How much do I need to save and what am I spending? And then last but not least, plan for charitable and passing on your wealth. This chart was alarming to me when I saw it. So if you retire at 65 and live 5 years after retirement, you'll need, and that's to have an income of about $100,000, you'll need $451,000 in a retirement account to have your money last just 5 years after retirement. If you live 10 years afterwards till age 75, $798,000 you need to have in a retirement account to comfortably get $100,000 a year to live. 80 years old, which is 15 years, one little over $1 million. 20 years after to 85, $1.2 million you need in retirement accounts. Age 90, 1.4, and 95, if we're blessed enough to live that long. And remember, as we get older, our healthcare costs are going to go up. So that $100,000 a year that we're estimating, we may need more. So it's important to think about how are we going to invest that money. So here is a chart about what it means to be conservative, moderate, and aggressive. So if you're in a conservative portfolio, that's probably, your mostly your checking account, your savings accounts, maybe a few cash alternatives like treasuries or municipal bonds, and a very small portion in stock. But remember, you're only going to get about a 2% gain at the most, because right now, we know, savings accounts at the bank are literally paying us 0.15%. So if you look at a moderate portfolio, which is more of a 50-50 split, you're probably going to average about 5 to 6%, which could get you to that goal. But when we're younger, in our 20s to maybe 50s, we can be a little bit more aggressive with our investments, which are going to get us a higher return. But as we get older, it's very important that you speak to your advisor about risk, because the last thing you want is to retire in a year like 2007 to 2009, because in those years, an aggressive portfolio lost approximately 40%. So if you were on track at 65 to have that amount that we discussed in the previous screen, but then the recession happened and you lost 40%, then what? Then you'd have to reassess your goals and say, okay, maybe I need to continue to work longer and I can't retire at 65. So that's why it's important to really look at those plans and tweak your growth. And remember, it's not always about the return. It's more about the goal than the return. So here's just investment options, just a little screen to go over what investment options are that I spoke about. So cash alternatives, It goes over the advantages. It's predictable. It's liquid. There's little risk to principal, but it may not keep up with inflation and it'll have relatively low returns. So bonds, which I spoke about, could be corporate bonds, it could be municipal bonds, it could be treasury bills, T-bills. It's a steady and predictable stream of income. The income is typically higher than cash alternatives. It's lower risk because remember, any type of product that is not in the bank, it's not a bank product and it could lose value. There's always risk of that. There's some of the disadvantages. There's risk of default. The value of the bond will fluctuate with interest rates. Lower risk also means lower potential returns than some stock. So stock, the advantages are it's historically it's had a higher rate of returns. You own it and it can provide income through dividends. And it's easy to buy and sell them right in the secondary market. However, some of the disadvantages, poor companies could affect the results and the value. So it's important to invest in solid companies and not risky companies because you may lose value. It's also subject to market volatility, as you're probably seeing right now. It's a roller coaster ride. Every time something happens in the market, for example, with the Ukraine and Russia and COVID, it's going to affect the market. So there's always going to be market volatility, which is a risk to our principal. Other investments could be things like hedge funds or separately managed accounts. You do have ownership rights. It's easy to buy and sell, but there's risk to principal as well. And mutual funds, are nice because it's a diversification of many different stocks. So you don't just own one stock, you may own multiple stocks. And you can also choose if you want to be socially responsible, what political affiliations you want to go with and stuff like that. And they're professionally managed as well. And the value of shares fluctuate just like the stocks do based on the market. So that's that. And so caregiving and estate planning. These are some things that I always say are very important to do. It's important to look at how your accounts are titled. And one thing that's not mentioned here is also beneficiaries. It's also important to put beneficiaries on your accounts because they will bypass probate court if you do have a beneficiary in place. And beneficiaries on bank accounts actually increase your FDIC coverage. And there's a great website that I like to use, which is fdic.gov. And they have great tables that you can use to calculate your FDIC coverage. It's important to have a will in place. It's alarming how many people don't do a will because talking about death is always something that we don't want to talk about, but it's important to do that because when we have young children, it gives us the opportunity to state our wishes for our guardianship of our minor children. It tells us how to distribute the estate because if you don't have one in place, it goes to probate and then they decide how it's distributed. Picking an executor is also very important too because you want to pick somebody who is going to follow your wishes after you go because once you're gone, you don't know what happens. And they're in charge of distributing your assets to all beneficiaries. And also while you're living, it's important to have a power of attorney. And I hear my dog whining and I apologize. Power of attorney, which establishes how you want things to happen. You can have a financial power of attorney and a personal care financial attorney. So the personal care financial attorney determines like your health care wishes and like that. A property helps you pay your bills and everything like that. And choosing a trusted advisor is very important too. And understanding how they're regulated, how they're paid, what does reporting look like, how often do I get them, how transparent are their fees, and are they keeping up with how my plan is going? Are my goals being met? Is the plan reaching my goals? And next steps. It takes just as much energy to wish as it does to plan. And you're never, ever too young to start planning. And I am going to turn it over to Rachel now, who's going to do her thing. And thank you so much for putting up with me and listening to me. And I hope you got a lot out of it. And if you have any questions afterwards, please feel free to ask.
Good afternoon, everyone. I'm Rachel. I work at TD Bank, like you know. I am the store manager of our Washington Township office. I'm really excited to be here today. I'm always happy when someone allows me the time to talk to a group of people about money management strategies. I'm confident that if you try these strategies and you apply them to your own financial plan, you'll be set up for success. Before the end of the seminar, you will understand the importance of good money management habits. We're going to talk today about how to optimize your budget, create a savings plan, and tips to improve your net worth. These are all key strategies to thriving in times of change. Excuse me for just a minute. I actually can't get my PowerPoint to advance.
I'm glad I'm not the only one technologically challenged.
It did work during the run through. I apologize. Just bear with me 1 minute. It actually looks like my WebEx is frozen. Denise, can you still hear me?
Absolutely, I can still hear you.
My WebEx is completely frozen right now for the PowerPoint as well as the actual WebEx itself. I can't even get out of my screen. So I saw a couple questions come up for Rebecca. Maybe you have Rebecca answer those questions while I work out my PowerPoint.
Absolutely. And Teresa, if you have any advice for Rachel, please chime in. But Norman asked a question, and I think this kind of related with some of Rebecca's slides about asset allocation and investment options. The question was, does real estate fall under cash alternatives?
Yes, that would be a cash alternative. And remember too, real estate is not always liquid because it's only as good as getting the seller to buy it. So, selling and buying. So,
Great point to remember. It really depends. And then
right
another
now
question.
it's a great time, but maybe 5 years ago the market wasn't what it is right now.
Another question from Michelle, what would be a reasonable fee range to think about when you are asking or planning for financial assistance, working with somebody like yourself in financial planning? And you talked about transparency of fees.
Yes. So I know my team, we charge, if it's up to $1 million, we charge 1% to manage the money. And that's all in 1%. So, and when they quote you the portfolio, make sure what they're quoting you, the returns, are after the fees come out, because some of them may not do that. And also mutual funds look like they don't charge anything. If you went out and bought a mutual fund, there's embedded fees within the mutual fund. So it's important to look at that too, what the fees are for the mutual fund. If it goes over $1 million for us personally, the fees go down. So the more you have, the lower the fees. I've seen some companies in the past that I've worked with charging 1.5% up to $1 million. So it's all relative. But I would say 1% is a good fee to look at up to $1 million for it.
1%. Thank
Mhm.
you. A tip for Rachel, try closing as many of the other applications as possible. Did you see that? We all work as a team here.
could also, if you want to send me the presentation. Oh, it looks like it might be working.
Oh, I see it. Oh, yay, I see it. And go to slideshow. There we go. I see it.
Okay, sorry. I didn't have too many applications open. It kept freezing. So, hopefully it won't freeze again. So thank you so much for your patience, everybody. My name's Rachel. I am the store manager at TD Bank in Washington Township. Excited to be here today. I love to talk to people about, just being aware of your finances and how to achieve your dreams. And I love to talk to people about the right behaviors and routines to get yourself the things that you want in life, and to really feel that financial freedom. So some things that we are going to talk about today are, we're going to review some tips for saving money in your daily budget. We will talk about how to identify and define your monthly budget items, both fixed and variable. We'll talk briefly about how to create a savings plan and basically how to design a plan to help you achieve your dreams. We're also going to talk briefly about how to improve your net worth and what net worth is. And we'll discuss assets and how to pay down debt. So first, let's talk about why people, I'm so sorry, it just keeps freezing every time I try to advance. Okay, so first let's talk about why people don't succeed financially. I'm not referring to times when unusual circumstances occur that suddenly put finances in a tailspin. Some things are out of our control, but for most of us, it's our spending decisions that we make throughout our life that put us where we are financially. According to the Financial Health Network's 2020 Pulse report, only 33% of Americans report feeling financially strong or that they're financially secure in managing their money in a way that benefits their future. So we're going to talk about budgeting. And I think once you move forward and have a budget plan in place, even when you run into that unusual circumstance, you'll be in a better place to tackle it. And you won't feel like you're being pulled down financially. Without effective money management skills, you can become vulnerable to severe financial crisis. But with the right evaluation, planning, and in particular changes in your own spending habits, you can not only be prepared for an unexpected hiccup, but you can also gain that financial freedom that I mentioned earlier. You'll be able to save for long-term goals and dreams like buying a home. Maybe you're thinking about going back to school, you need to fund that education, or financing your retirement like Rebecca was talking about. So let's review a few strategies today. So number one, let's talk about making a budget, because having a plan for your money is key. Without a plan, that's when we make those impulsive buying decisions. You should always plan to cover your needs first, right? Your needs are your rent, your groceries, and your utilities, just to name a few. So the first strategy is to make that budget and live with it month over month. Well, how do we get started? The simplest and most popular budgeting strategies, the most popular budgeting strategy is the 50-30-20 rule. This breaks your income up into three categories: your essentials, your wants, and your savings. This will help you learn what to do with your paycheck, weekly or bi-weekly, however often you get paid. So first of all, half of your paycheck should cover your essentials, right? And we said your essentials were your rent, your groceries, your utilities. 30% is for you, and the remaining 20% should go towards your savings goals. You should keep one central location to track your spending and your income. Tracking it will help you hold yourself accountable, and it will allow you to know exactly where your finances go. If you've never actually sat down and done a budget before, it can seem a little overwhelming. Sometimes it's intimidating and it's actually hard to sit and see where your money is going and to acknowledge it. There's a ton of tools out there. So there's pre-prepared spreadsheets online. There's budgeting apps. A popular budgeting app is called Mint. I don't know if any of you use it now. But nothing is more relieving than fully understanding and actually taking a hold of your financial situation. I have a girlfriend that I'm very close to, and her and I always check in with each other and we talk about financial freedom, and we'll communicate if we pay off a credit card or if we achieve something that's a milestone like that. Before you detail your budget, sit down and consider what your financial goals are. These accomplishments should be focused on steps to help you stop living paycheck to paycheck. And you can break that cycle no matter how old you are. A priority in this situation should be to build your savings account. So start out simple, right? Set one goal, say that you are going to save $1,000 and just focus on it. $1,000 should be enough to cover a rainy day or an unexpected cost that pops up. Some people skip the rainy day fund and they go right for something called the emergency savings. They say that around 3 in 10 adults have no emergency savings. The recommended goal for an emergency savings fund is approximately 3 months worth of living expenses. So living expenses are everything from your rent to your utilities, car insurance, everything you need to survive for 3 months with no income coming in. Number 2, let's talk about how to track your spending. It's very easy to spend more than we have or more than we have coming in if we don't maintain a budget and we're not tracking and looking at our spending. That's why it's very important that when you start this process, you actually sit down, pull several bank statements, look at where your money has gone over the past few months. This will help you actually plan out your budget. And you don't want to end up like 65% of Americans who actually say that they don't know where their money went over the last month. It's a really great first step in identifying your spending habits and learning where to cut costs and how you can improve. Don't forget to plan for those larger expenses, right? We all have birthdays. We all celebrate holidays. We have annual dues for different things. So put these expenses on a calendar and plan ahead. But more importantly, to make up for those, figure out where you're going to cut back on that month's expense to make up for that birthday present that you need to buy. Number 3, cut costs where you can. Once you've looked at the 50-30-20 rule and you've pulled your bank statements and you have a full understanding of your spending habits, that's when you can start to work on trimming down your essentials and especially your wants and begin saving. Some really great ideas to cut costs are calling your service providers, trying to negotiate with them, your internet, your phone service, cable bill, auto insurance. I think now I have more friends that actually don't have Comcast at all and they just pay for Netflix. I don't know about you guys, but Comcast is a very expensive bill. So just some ideas, think about what you need and what you actually use. Again, check on car insurance and things like that. Eliminate those unnecessary expenses. I know for me, the amount of money that I spent at Wawa every day in a 3-month span was eye-opening. I spent a lot of money on going in to get cups of coffee while I'm there, grabbing something else, a little bite of this, and maybe lunch. So I don't go to Wawa every day. A few years ago, I actually stopped. I buy coffee. I make my coffee at home. I pack my lunch. And it was, an adjustment, but you get used to it. Your cutback should start with items that you wouldn't miss. For example, car insurance. You're not going to miss having an old car insurance company. You're going to be happy that you're getting a cheaper rate with your new one. We hear it all the time, right? Eating out is costly. Having food delivered is costly. Really making the time to prep your meals so that you're not running to Wawa at lunch or going through the drive-through. If you still can't get that 30% right away, the extra expenses should come out of your wants money. So when we talk about the 50-30-20, you have to stay within that window. So if you're at over 30% in one area, then you need to decrease another area to make up for it until you can get where it should be. Adjust spending as needed. If you found your budget isn't where it needs to be, get prepared to make changes, right? Look at how much you are over budget and decide where you can cut it from. You should never rule out items like groceries, utilities, and rent because they're your necessities. Start a side hustle, right? Everyone has a side skill. If you're somebody who's relying on credit cards to live between paychecks, if you've ever found yourself taking a payday loan or borrowing money from friends and family to manage those necessities, then it's definitely a good time for you to consider an alternative way to pull in some extra income. There's a ton of freelance work out there, right? We're considered in a time of the gig economy. You can drive for rideshare, you can pet sit, you can work in a restaurant on the weekends. There are so many different opportunities right now to make money. Think about something. I see people starting side hustles and selling things on Etsy, just until you can get yourself to where you need to be. Number 5, embrace minimalism. Minimalism is a great way to save money and to reduce stress. When you look at the things in your life and the things in your home that surround you, start collecting only the things that really bring you joy and a clear benefit to your life. This will help you stop impulse buying, and it will also improve your lifestyle habits. So clean out your house, get rid of clutter. All those items that you're getting rid of, some of them you can sell on Marketplace or different apps to make some quick cash. Another option is to donate valuable items for a tax deduction next spring. I know where I live, I do VA pickup, and I committed to myself to do VA pickup once a quarter. And it feels good to donate the items. I get the tax deduction, and it's not work for me. I'm cleaning out my house anyway. I put the stuff on my front porch and they come pick it up. Number 6, stay motivated. It's important to remember that budgeting is definitely a lifestyle shift. Choose a friend or family member to keep you on track in your savings and your budget goals. When you need a boost, check back in with your goal and how much closer you've come to building that emergency fund. Just putting a plan in place is a huge accomplishment. So when we talk about staying motivated, that's when I'll refer back to my girlfriend, Lindsay. We check in with each other. We have some of the same interests. We both follow on Facebook. It's called Ramsey Baby Steps Community. You'll see at the end of this PowerPoint, there's a resource page. I'll reference Dave Ramsey a couple times. And his baby steps. He talks about like how to pay off debt, the snowball effect. Her and I both have an interest in him. So to keep each other motivated, we check in, we send each other screenshots, we'll tag each other on that Facebook page group. So just some ideas I figured I would share with you that work for me. Let's talk about saving for your goals. We've talked about cutting expenses and budgeting. So saving for your future goals. We all have goals in our lives, right? We all at some point will have a goal that requires us to have some money saved. The best way to get started is to look at your goal and put some specifics around it so it becomes less of a wish and more of a destination and a plan. So let's look at the goal itself. The most effective goals are set using the SMART criteria. I'm sure most of you are aware of the SMART criteria. The S in SMART stands for specific, right? So ask yourself, what exactly do I want? Well, I want to purchase my first home, let's say. The M is measurable. Well, how much is my first home going to cost? What is my budget? Okay, I'm going to purchase my first home, and I would like my budget to be in the range of $250,000. And I know that I'm going to need 10% down. Okay, so now we're on to A, action oriented. Well, what steps? How am I going to action myself to get there? I'm going to have to do research. Are there programs for me? How much do I need to save for my down payment and closing costs versus what I have? Reachable. Ask yourself, is this goal something I can actually reach? So I'm setting this goal for myself. I want to purchase my first home. What happens afterwards? Am I able to continue to live that lifestyle? Will I be able to afford not just the mortgage itself, but the actual housing expenses, the repairs, the insurance? I want to set myself up for success. And then the T is time bound. When will I reach this goal? So I know that I need to start saving, and I would really like to be a homeowner and stop renting sometime over the next 5 years. Once I have all that information in place, I can start to set steps to help myself actually achieve those goals. Other suggestions, write down your goals, right? I think Rebecca talked about a vision board. Post them where you can see them every day. I did this with my team in Washington Township. We made a vision board. Everyone had to set a goal for something, a purchase they were working towards, or something that drives them for why they come to work every day. Someone put that they needed a new kitchen. Someone else put that they needed to purchase sod for their house. And someone else posted college. They have a child going to college. So we have that posted in the back, and we check in with each other. Sharing these goals with other people, it helps you hold yourself accountable. How's that going? And then try not to focus on too many goals at once. So remember earlier we talked about maybe setting a simple goal of setting that rainy day emergency fund of $1,000 and creating a budget. Maybe start there. So once you have a goal, how can you plan to save for that goal? While many goals involve money, let's be realistic, right? And the only way you can achieve them is if you have enough money. Well, how much is enough? Because you need to know. So let's go back to that first time home buyer. They have a goal of purchasing a home that's $250,000, and we know that I need to save. I have to have $25,000 down to meet my 10%. So let's say that I have $5,000 saved already, and I want to do this in 5 years. Well, then it's easy to do the calculation, right? So $20,000, let's say divided by 250 weeks. I know I need to save $80 a week if I'm paid weekly, or $160 bi-weekly. If I commit to that and stick to it, I will have the $20,000 that I need in the end of the 5 years to purchase my first home. All right, let's talk about net worth. So now you can make a plan, you can save for a goal, you can budget. Let's discuss net worth. Net worth are assets minus liabilities. So it's everything you own minus all of what you owe. Examples of assets can be your checking and savings accounts, retirement accounts, real estate, automobile. Liabilities are your debt. So it's the mortgage that you owe, credit card balances, student loans, car loans, personal loans. How do you calculate your net worth? Well, you take an inventory of what you own as well as your outstanding debt, and then you can calculate your net worth. On bankrate.com, there's actually a net worth calculator. Take a peek at it. You should know what your net worth is. Getting yourself in a better place with your net worth should also be a goal. Well, how do you increase your net worth? Well, we said it's your equity minus your debt. So lowering your debt increases your net worth, paying off those loans slowly. And that's when I'll go back to Dave Ramsey when he talks about the snowball effect. So check that out when you have time. You should make smart investments, not just in stocks, but that's a surefire way to increase your net worth. Live within your means, right? Because if we said net worth are your assets minus your liabilities, don't live extravagantly. Don't live above your means. Keep your luxury expenses at a low. Buying a sensible car, right? Buying a home that you can afford. Net worth doesn't mean that you're rich. It just means that you have a positive net worth. And a lot of people will set a financial goal for themselves to just simply have a positive net worth. Okay, so now that we've talked about net worth, let's talk about mortgages. Because a part of having a positive net worth would be getting yourself in a place where your home is paid off. That's something that we would all love to do. So just to touch on this pretty quickly, Most of the time, people will take out a 30-year mortgage. And the reason is it's easier to qualify for. Your monthly payment is lower. It usually fits in a budget. What happens with a 30-year mortgage is in the beginning of your loan, in the beginning of any loan, if you were to look at your payment or your receipt, you would see that the majority of that payment is going towards the interest, right? Because we pay interest on loans. As the length of the loan goes on and time goes on, the majority of your payment more and more goes towards principal and less towards interest. Once that starts happening, that's considered like the hallmark part of the loan. That's what we all want. While there's ways to make that happen sooner, and I'm going to go over a couple of them with you. Before I forget, I want to make sure I mention, if you've never done so before and you do have a mortgage or you're looking at getting a mortgage, go online, take advantage of something called an amortization calculator. And it will allow you to look at how long, what it looks like, how much interest you'll pay if you just make regular payments. Let's say you're someone who gets a quarterly bonus. Well, if you were to take that quarterly bonus of $500 and pay it on your mortgage each quarter, what will that do to the length of your mortgage? What will that do to the interest that you pay? So it's really cool to look at that. It's important, especially if you want to pay off your mortgage sooner than later. Other ways people will shorten the life of their 30-year mortgage, they'll make principal payments, right? If you make additional principal payments, even if it's $50 a month, it will eventually shorten your loan and decrease the amount of interest that you pay. Some people will choose to just make one extra payment for the whole year. So if you pay your minimum payment every month, you make 12 payments a month, 12 payments a year on your mortgage. Paying a 13th payment will actually shorten the life of your loan and decrease the amount of interest that you pay. Some banks will offer you the option to pay biweekly. So biweekly would usually come out to be 12 payments. If you pay biweekly, that's another way to pay that 13th payment for the year. Other people will start out with a 30 and then choose to shorten it, right? They'll opt for a 15-year mortgage. Why do they do that? Well, usually the interest is lower. The life of the loan is lower, but you have to be prepared because your monthly payment is usually going to be higher. So these are just some different options and things to think about. So we spoke today about a few topics. We talked about ways to manage your budget, how to create a savings plan, ways to increase your net worth, and we touched on mortgages, potentially how to shorten the life of your mortgage and also save on some interest. There's a ton of tools, there's books, there's websites to help you along the way. This resource page is for you. Again, I follow Dave Ramsey in Baby Steps Community on Facebook. I also use Credit Karma. Just a couple of these things aren't on here, so I just figured I would share personally what works for me. There is the amortization calculator that's on here. Find your net worth. We also talked about earlier in the PowerPoint, the Mint app for budgeting. And I just want to touch again on something that Rebecca said, because being in a TD location and talking to customers every day, I get a lot of FDIC questions. So I usually always direct customers to the FDIC website, to that ED calculator that Rebecca was talking about. It helps you feel confident and comfortable that your money is insured with whatever bank you're at. So I hope this was really helpful. I enjoyed being here today, and I'm going to turn it back over to Denise now.
Gosh, so much information. And honestly, as a team, Rebecca, Rachel, you gave us an amazing big picture awareness and strategy, as well as a very, practical day-to-day advice you furnished us with. So thank you for that. To the audience members, I wanted you to know that in your reminder and email, in your email reminder that was sent to you today, there was a link to the resource page that Rachel was talking about. So please go back to your email and check that. Just open that up and look at that. It's called the Know Before You Go with the web link to get to today's event, but look at that for the link to the resource page that Rachel showed us for a lot of those great, you know, websites and the mention of Dave Ramsey's book, Financial Peace Universe. Also, Rachel, you mentioned, was it through LinkedIn for Baby Steps? How do you get to Baby Steps? Baby Steps is a community?
Yes, so it's just a Facebook page that I follow. It's called Ramsey Baby Steps Community. It's just a preference of mine. It's not for everyone, but it's just a reminder for me.
Beautiful. One mention from Norman was also lower PMI. Can you explain that a little bit?
So just be aware, if your down payment is less than it, then if you make your down payment for less than what is required, you're usually responsible for paying PMI. I forget the percentage. It's been a while since I've done anything with mortgages, but
20%.
yes, thank you. So 20%, once you hit that 20%, your PMI can drop off. So that's why it's really important, like when we talked about purchasing your first home, having the full 20% to put down, because you can end up saving monthly on your mortgage payment.
That's great.
Also, too, if you did your mortgage 3-4 years ago and bought the house, with home values going up, you can look at refinancing early and getting rid of the PMI by refinancing.
Is there a point where it's too late to really look at refinancing? Maybe you just if you only have a few years left, what would your suggestion be for that?
So that's a great question. When I have customers that come in and they want to do things like refi, they want to do some sort of home equity, we look at what are you currently paying, what's your interest rate, and how much time do you have left on your loan? Because you're not gonna, usually a customer will not want to refi if they're towards the end of their loan because they're almost there. And really, what's the purpose of the money? Do they have an expense that they need to do? Are they taking out a home equity loan for home repairs? So it's really case by case. But definitely if you're towards the end of your loan, a customer will usually choose not to refi at that point.
Thank you. That's extremely helpful. Another audience member was asking, would you be willing to share the content of your PowerPoints? That resource page, honestly, Rachel, was fantastic, but if either one of you would be willing to share the content of your PowerPoints for, for audience members to really break that down and digest it a little bit more, have more time to digest it, that would be extremely appreciated.
We can absolutely do that. And I don't have a problem with that. I'm sure Rebecca doesn't either.
I don't either, no. And I believe, did we send it to you, Denise, before the presentation or no? Because I could always email it to you and then you can disseminate it out if you'd like.
If you wouldn't mind doing that, I'll go back and see. Just if you wouldn't mind emailing that to me, that would be amazing.
Perfect.
If you go into TD Bank's website, there's actually a link. You don't have to be a customer. We don't try to sell you anything. We actually have a financial literacy link on our website. There is a ton of great information on there. I think it's actually referenced on the resource page. And there's stuff for all ages. So if you're looking to provide some information to a younger child, high school, it's really for everyone. And there's a budgeting tool in there as well.
And there's a lot of links for TD Wealth as well with similar resources, but I will definitely share my presentation.
Awesome. I'm just typing a couple of these things in. So definitely for audience members, we recommend that you go to the TD Bank website and look for, I saw TD Bank Learning Center. Rachel, you included this on the resource page, creating a budget interactive module. And also with TD Bank, so it would be www.tdbank.com/financial education. So you'll see that on that resource page. This just about wraps it up, and I just wanted to again thank TD Bank, thank Rachel, thank Rebecca for being here and sharing your expertise. This has been so educational, I think, for all of us. Sincere thanks for being here. We also thank TD Bank for sponsoring so much of our programming and being an incredible supporter of Rowan University.
Norman's saying he wants to ask one more thing.
Oh, let's see. Norman, talking money with people can be touchy. I've lost friends. It's really nice that you have someone to bounce some strategies off against, with. So good, that is really good. I loved Rachel's suggestion.
Yeah, I've actually been really lucky. My girlfriend is someone who has always to me seemed very smart with money. She's had to deal with a lot financially at a young age. So at one point, I just wasn't scared to go to her and say, this is what I have going on, and I think you've overcame this. Like, talk to me about what you did. And now just ever since then, we're comfortable with each other. So if you can find someone, make sure you do that. That's also what bankers are for. You don't have to come to TD. You can go to wherever you bank at. That's what we're for. We're there for professional advice and to offer you education.
Rebecca, did you have one more thing?
No, I was just going to say the same thing. It's as a, advisor, as a woman, I personally find that women tend to listen better. That's just me. It may not be true always, but if you ever have a question, my email is on the presentation. Please feel free to email me, ask any questions. Just because you have a question, it's not, it's free to ask a question. And any question's a good question. A bad question is a question that's not asked.
Beautifully put. Well, listen, thank you so much for joining us today. Your time is so valuable. We recognize that. And just for the audience members, we have another event in April, another WAN event we want to bring to you. It will be a virtual event, so hopefully we'll see you then. Rachel, Rebecca, thank you. We look forward to seeing you again in the future.
Thank you.
Take good care of yourselves. Take good care, everybody. Bye-bye.